How to choose a good Forex broker. Choosing the right broker is not easy, especially when there are so many platforms offering like-for-like services. In choosing a Forex broker, you must consider the platform ease of use, reputation, and secure deposit, and easy withdrawal. Price is of secondary importance. Poor execution and slippage are also detrimental to success, and if you can't withdraw your funds, then it becomes worst. Watch this video to the end, and you will discover the best ways in choosing the best broker for your trading journey. Now let's look at how to choose the best Forex broker. 1. Regulatory compliance. The first thing to check when selecting a Forex broker is their reputation. In the United States, a reputable Forex broker will be a member of the National Futures Association, NFA, a self-regulatory organization for the futures industry. It will also be registered with the Commodity Futures Trading Commission, CFTC, which regulates the commodity futures and options markets in the United States. A flashy website does not guarantee that a broker is an NFA member or under CFTC regulation. A broker will typically provide its NFA member number on its website. Additionally, each country outside of the US has its own regulatory body. Due to potential concerns regarding the safety of deposits and the integrity of the broker, accounts should only be opened with brokers that are duly regulated. Brokers often boast of their regulatory status, however, not all regulators are equal. Check to see if the broker is registered by any of these regulators, the FCA, CFTC, FSA, or MAS. These regulators are extremely diligent in policing regulated entities. 2. Account features. Each Forex broker has different account offerings. Here are 4 areas to consider when comparing features among brokers. Leverage and margin, commissions and spread, initial deposit requirements, ease of deposits, and withdrawals. Let's look at these in details. Leverage and margin. Depending on the broker, Forex traders may have access to leverage in their margin account. For example, using 50:1 leverage, a trader with an account size of $1,000 can hold a position that is valued at $50,000. Some brokers offer as much as 200:1 leverage. Leverage works in a trader's favor with winning positions, since the potential for profits is greatly enhanced. However, leverage can quickly destroy a trader's account since the potential for losses is magnified as well. You have to use leverage with caution. Commissions and spreads. A broker that takes commissions may charge a specified percentage of the spread, which is the difference between the bid and ask of a Forex pair. Many brokers that charge no commission instead make their money with wider spreads. Know how your broker makes its money and shop around. For example, the spread could be a fixed spread of 3 pips. A pip is the minimum unit of price change in Forex, or the spread could be variable depending on market volatility. The wider the spread, the more difficult it can be to make a profit. Popular trading pairs, such as the euro to US dollar and pound sterling to US dollar, will have tighter spreads than more thinly traded pairs. Initial deposit. Most Forex accounts can be funded with a very small initial deposit, even as low as $10. With leverage, of course, the buying power is far greater than the minimum deposit, which is one reason Forex trading is attractive to new traders and investors. Many brokers offer standard, mini and micro accounts with varying initial deposit requirements. Ease of deposits and withdrawals. Each Forex broker has specific account withdrawal and funding policies. Brokers may allow account holders to fund accounts online via credit card, debit card, ACH payment, PayPal, wire transfer, bank check, or business or personal check. Withdrawals can typically be made by check or wire transfer. The broker may charge a fee for either service. 3. Currency pairs offered. There is a great deal of currencies available for trading, but only a few get most of the attention and, therefore, trade with the greatest liquidity. In addition to euro to US dollar and pound sterling to US dollar pairs, The major pairs include US dollar to Japanese yen and US dollar to Swiss franc. A broker may offer a huge selection of Forex pairs, but what is most important is that they offer the pairs which interest you as a trader. Check on their websites for the currency pairs offered before deciding. 4. Customer service and support. Forex trading occurs 24 hours a day, so a broker's customer support should be available at any time. Also consider whether it's easy to get a live person on the phone. A quick call to a broker can give you an idea of the type of customer service they provide and average wait times. Trading platform. The trading platform is the investor's portal to the markets. As such, traders should make sure a broker's platform and software comes with the technical and fundamental analysis tools they need, and that trades can be entered and exited with ease. This is very important. A well-designed trading platform will have clear buy and sell buttons, and some even have a panic button that closes all open positions. A poorly designed interface, on the other hand, could lead to costly order entry mistakes. Other considerations include customization options, order entry types, automated trading options, strategy builders, backtesting features, and trading alerts. Most brokers offer free demo accounts so that traders can try out the trading platform prior to opening and funding an account. Choosing a Forex broker isn't as easy as it first seems. It is certainly worth investing the time in researching what's on offer and ensuring that the broker you choose is investing in your future as a loyal long-term client. Do check on other earning videos on our channel. Subscribe to our channel, click on the notification button. Thank you for watching.